People liked what they heard out of Janet Yellen, in part because she was sounding a more optimistic note. And the sense then is that the economy is going to be in good enough shape to support the valuations we're seeing. What about concerns about an asset bubble, though? We heard her say, well, we're well within the historical norm, but there are people out there that worry we could see a repeat of what we've seen before. Mark.
Well, I mean, clearly assets, if you look at how investors allocate a dollar of capital, can go to stocks, bonds, or cash using traditional asset classes, are favoring equities because there is no other game in town at the moment, and not likely to be, given what we heard, of course, from Janet Yellen in terms of the considerable period of time being reiterated, which is measured probably in 6 to 9 months subsequent to the end of QE before you even get a hint of a change in interest rates. So as a consequence, equity prices, I think, are destined to go higher. The question is at what level they take on bubble-like characteristics, and with the liquidity on the sideline and the fact that if you look inside the benchmarks, actually the average stock is not performing as well as the headline benchmark is, there's a lot of catch-up to be had, which means money managers are going to be desperate to put money to work.
They want to get those good names.
Yep.
Okay, so what is that level where it starts to look really frothy? I mean, people have pointed to 20,000. Hey, we got a long ways to go before we're at Dow 20,000.
Yeah, I think if you look out across the spectrum, I think Mark's right here. Equities tend to be the only game in town, but where you're going to find the bubbles are in the sort of shadow neighborhoods, right? The private debt places, the private equity places, and we've seen valuations in M&A activity reflective of very rich valuations, maybe not bubble-like valuations, but very rich valuations. And so if this trend continues, I think that's where you would start to see
But then again, hey, if you get what, you know, I had an economist on the other day saying he thought we were going to see 5% growth. That might be a little optimistic for the second quarter, but if you get that kind of economic rebound, it might be able to justify some stuff.
Justify junk bond yields being at record lows. Justify the spread between investment grade and junk bonds being at the narrowest since 2007. You can't justify that without the central bank being in the game. I want to know why stocks are higher today. I didn't hear anything from Janet Yellen that should push stocks this
Well, let's listen to what she had to...
In fact, no, here's the point, Trish, just quickly. The point is what she didn't say. A lot of people anticipated Janet Yellen to come into here and try and take some of the froth out of this market. She backed down. She didn't do it. And that's one of the big reasons why we are high today and yields are staying lower.
The other thing, though, I think is the fact that she was also very committed to not being overly dogmatic with regard to Fed policy, which is to say she said we'll basically accelerate or decelerate our activity, whether it be on QE or the function of the glide path of the Fed funds rate, predicated upon the speed of economic activity. And I think the market welcomed that they took a view that they weren't going to be hard liners in terms of QE ends. We immediately start raising interest rates, and we're on our way to normalization.
Let's listen to what she had to say on the economy rebounding right here. Take a quick listen.
The committee thus believes that economic activity is rebounding in the current quarter and will continue to expand at a moderate pace thereafter.
Okay, so your reaction?
Well, look, it's going to expand at a moderate pace because there's all sorts of headwinds. There's very high levels of public debt still going on. There's low household formations due to student loan debts accumulations. There's large structural problems sitting in the U.S. economy that will impede it from hitting this 5% growth or even a 3.5% growth, which would be absolutely stellar given the kinds of challenges that this economy has. So
challenges also being the labor situation. I mean, when are we going to start seeing some kind of wage inflation? When are we going to start seeing that participation rate shrink? I mean, or rather grow, I should say, because right now we have so many people that have just said enough and they're not in the labor force to begin with.
Can I say just a quick thing on the labor force participation rate? She said the most clarifying statement today. Look, part of it's demographic. Let's get over that. There used to be a time in the late 70s and early 80s when the labor force participation rate going up was actually the bad thing because it meant two people had to work to support a household, and now we're worried about it coming back down. These things are structural. Part of it is cyclical, and it's going to take time to work itself back into an equilibrium.
If they are structural, gentlemen, sorry, Julie, what can the Fed really do about it? Probably nothing. So, but she's been saying for a while that it's cyclical. Do they have to back down from that now?
Well, I think they have to be open-minded with regard to their commitment to whether it's structural or cyclical. I mean, the Philadelphia Fed, for instance, under Charles Blosser, did a study that showed that basically two-thirds of the decline in the participation rate was due to baby boomers retiring and people becoming disabled. And so really only about a third of that is attributed to discouraged workers leaving the workforce. So maybe the participation rate isn't necessarily the metric that is as important in being able to identify or measure the amount of slack that Janet Yellen keeps focusing on as to why the Fed is likely to be lower for longer.